Hello. I'm super excited today to welcome Paul Anthony Claxton. He's a former United States Marine turned entrepreneur and a venture capitalist, now managing partner of Digerati Investments, a $60 million AI focused seed and Series A fund based in Southern California. He's driven on 4 combat tours in Iraq and over 2 decades of business experience. He brings a rare combination of discipline, risk management, and operator empathy to early stage investing. Before becoming a full time investor, Paul built and scaled multiple companies which shape his philosophy that founders must be both technologists and capital allocators, not just storytellers. At Digerati, he follows back what he calls technologically founded elite. So, welcome, Paul. I'm super excited to have you here with us today and learn more about what you're doing, how you're doing it, and why you decided to do it that way. So, for context, um, tell me, like, I'm just super curious, what made you go in the Marine in the first place? Like, what was the driver for you?
Well, it's an interesting question. My father was a Vietnam Marine,
Okay.
and you know, the household that I grew up in was very militant.
Okay.
My dad was what you call a Marine Corps drill instructor. If you've ever seen the movie Full Metal Jacket with Lee Ermey, my dad was that guy.
Okay.
So, I think military was kind of ingrained in me. Um, After playing sports in high school and realizing that, you know, my academic future wasn't the brightest future, I thought anything physical could be a much brighter future for me based on, how I performed in high school and
Hmm.
where my efforts were. So I thought the Marine Corps could be that, and I didn't join the Marine Corps to I think everyone has their own reasons.
Yeah.
But for me, I just wanted the challenge of doing what it took to become a Marine, and I thought that challenge was entirely physical, and uh, I had a rude awakening that it's actually more like mental than anything. So I think ultimately that's what led me to the Marines, is just wanting that challenge and wanting to be a part of something great,
Hmm.
and looking in comparison, to different branches of the military. Um, you know, each one has their a specific function and heritage in
Hmm.
their own right. But the Marine Corps is widely known for being a very testy branch, a very intense way to serve in the military, and so their training is very, very difficult, and that's what I wanted. I didn't want it easy, and the Marine Corps certainly gave me all that it had to offer within that respect.
But you said that the Marine wasn't as, I mean, obviously this, like, it's one of probably the toughest physical endurance challenge that one can impose on themselves. But you said that a lot of it was mental. So kind of like, what are some of the mental lessons that you took away, and how are you parlaying those into what you do now?
The mental lessons are, um, just it's really the bricklayer's philosophy, right? Like, how do you build a wall? Do you
One
build a
brick at a
wall
time.
section by section or brick by brick, right? And so
Yeah.
and it's all about just laying that brick
Hmm.
perfectly,
Hmm.
perfectly, right? And so the Marine Corps is very much the same. It's like every little thing that we do, we used our drill instructors used to make us yell, and everything that we do, speed and intensity, sir, speed and intensity, like repetitively, like it was some kind of Spartan chant or something.
Yeah.
But you know speed and intensity in everything that you do like your utmost effort, even if it's the smallest thing,
Mm-hmm.
speed and intensity with everything you do. And then, the other thing is, it's never as bad as you think it is.
Mm-hmm.
Because at the end of the day, the only thing that really matters is, emergence, and then essentially, like our emergence into life, right? And then the next evolution, right? So the emergence into life, and then when that essentially dissipates, and when we dissipate and form, and return to you know uh, the earth,
Mm-hmm.
to the organisms of the earth, or if we go on to another parallel universe or something, at the end of the day, that little blip on the radar screen while we're here,
Yes.
that from that beginning to that dissipation is really the only thing that matters. So basically life and death is the only thing that matters, and everything else in between does not, right? And
Mm-hmm.
so at the end of the day, what you think matters doesn't really matter, right? And so what that really means is when you're doing something, you think about, what does anyone think about this, or what if I fail? It doesn't matter. But yet at the same time, everything matters, right? Because the smallest little mistake can derail you from your objectives, right?
Mm-hmm.
So does that make sense? So it's kind of like a psychological up,
Mm-hmm.
and a reverse, and a psychological down, or a reverse psychology. It's like forward psychology, reverse
Yeah.
psychology. So the Marine Corps teaches you that, and if you I think by adopting that mentality, I'm able to mentally deal with things that before the Marine Corps I would have never been able to deal with. But it's this repetitive
Mm-hmm.
psychological adoption
Yeah.
that allows us, that has allowed me to deal with things on a mental level that are really, really difficult, right?
Yeah.
So, and that's that. I hope that answers your question.
No, it does. I mean, the one thing that we find common, it's almost like what you're describing is like speed, intensity, grit, psychological
Mhm.
strength. Those are all like the things that every investor looks for in a founder. And when we're pitching story, we try to highlight if somebody has been in the military, if somebody has been a farm kid, particularly in Canada. If you're a farm kid, you have had to be ultra resourceful to get stuff done. If you've been a Spartan racer, like it's that mental agility and that mental perseverance to be able to overcome challenges, because you've started companies, you've scaled companies, like it's not all fluffy clouds and pink sky. It's like there's a lot of ups and there's a lot of downs, and sometimes the you may have ups and downs in the exact same day. So it's kind of unique. I mean, based on what you're describing, the Marine sounds like phenomenal training and foundation for entrepreneurs and founders. How many people like following your footsteps?
Like how many people have followed in my footsteps and joined the
Yeah.
Marines, or like become an
No,
entrepreneur?
how many people from the Marines have actually followed in your footsteps and became entrepreneurs or became founders or became investors?
So I'll start with something that I'll answer that question by starting with something that my mentor always told me, and one of my mentors, and he's also now a dear friend of mine. But he always told me, you're never on top, you're never on bottom, but like you're always somewhere in between, right? So what
Okay.
that means is like there are people that are pulling you up, right? Like,
Mm-hmm.
so they're subsidizing you essentially, right? They're supporting you, right, from the top, right?
Yes.
With maybe they have a greater capacity, maybe they have more money or more relationships, but they're giving that to you to pull you up, right? To help you meet, your objectives, to help you be successful, right? But at the same time, there's people underneath you that are pushing you up the same. There's people underneath you that are doing work on your behalf, or and so forth, right? Like there's people underneath you that are advocating for you as a leader, right? And that does a lot for someone's own like kind of self-esteem and so forth. And so there's people beneath you, or not even necessarily beneath you. Maybe they have less experience, but it's kind of like the old saying, standing on the shoulders of giants. Does that make sense? Yeah. So when you make those people successful, when you make them successful, you're successful, right?
Yes.
And success can mean a whole lot of different things. It depends on what you define it as, right? But ultimately what we want to do is we want to build other leaders that can do much, can 10x us, right? They can 10x our leadership, right? So we want to 10x our leadership. So when you talk about like people like following my footsteps, I wouldn't necessarily say that people have lived vicariously through me, or necessarily vice versa. But what I would say is that I've had a lot of people that I've mentored, young veterans, and how'd you transition from the Marine Corps and this and that. And yeah, actually some of those people have gone on into venture capital, believe it or not. And I'm proud to see them there, and and I'm excited to see what they do here in the future.
That's amazing. I mean, I couldn't agree more with everything you're saying. Like one thing that they've adopted from Scott Galloway is that greatness is in the agency of others. But in terms of leadership, like I had a mentor at one of my in one of my previous roles, and he's like, Maxim, do you know when you're succeeding? I'm like, I mean, there could be so many different answers. I said, I'm not sure, but kind of like what the right answer is here. He's like, if you're not there and the team is high-fiving each other, then you know that you're succeeding, because you set the vision and they're executing. Yes, you're important, but you're not that important. It's kind of like they know what's necessary.
Yeah, absolutely. And just to capitalize on what you said, it gets it's not scalable to not build other leaders. It's not scalable,
Agreed.
And so, because
everything bottlenecks with you if you don't build them.
Sorry?
If you don't build other leaders, if you don't build people around you, everything bottlenecks with you. If they appears, the way that you describe it, you have people that are pulling you up and you have people that are pushing you up. So you have to do the same for them.
Absolutely. And in the Marine Corps, we have a leadership philosophy. Leaders eat last. So what does that mean? So I was in the invasion of Iraq, and at times we were rationed to one meal a day because we're invading a country, and their supply chain and logistics have to get through. They have to get through the MSRs, or the main supply routes, right? And and sometimes, depending on where fighting is happening and how intense the fighting is, those supply chains can't get through, right? And, so when food is low, that's why leaders always eat last. And it starts with that concept, but it can be used in other situations, right? And so like from the privates eat first, because it's really about the people that are making that are doing the work, right? And so from the top down, like the colonel has to ensure that his Marines have everything that they need to do their jobs. That's the point of it, but it's also about caring for people that are under your charge, and making sure that, that they have their Maslow's hierarchy of needs taken care of, at least, as best as you can in a wartime environment. So, and that applies to everything. So, leaders eat last, leaders lead from the front. And so leaders lead from the front, meaning that I will protect my people, right? And so this is like the top down thing, right? I'll protect my people, but leaders also lead from behind in that, I will not take the spotlight for their work, right? Like, so I don't need to be seen, I want them to have the credit. So, those are just some things that I was taught from the Marine Corps about leadership and many other things as well, such as self-improvement, always seeking self-improvement and being enthusiastic and taking initiative and all that kind of stuff.
Paul, when did you decide to go into venture capital? Was this something that you had contemplated while you were in the Marines and you were working on the idea? Like what was the pivotal moment, and what was the catalyst that moved you into that direction?
So pretty much it's just like people telling me no. Being deprived actually led me here, believe it or not. And so like when I left the Marine Corps, all I really wanted was a job to just, work at. And, but I wanted to do the best that I could in that job. Well, through a series of like continuously getting laid off, and then, just not being fulfilled on the job, being just, corporate, politics, I guess, if you want to call it that.
Yeah.
After 6 years of doing that, and then got laid off, I would work myself up, and I get a really nice paying job. And then like, for some reason it wouldn't work out. And I keep finding myself in these positions. And like, I'm used to like, when I left the Marine Corps, I was 28, bringing in like $4,000 a month after taxes. Like, I was doing pretty good for a bachelor. Right. And so, I'm used, I have a comfortable lifestyle. And then I went to corporate and it's like, whoa, it's like, whoa. So just because I have a bachelor's degree and I have all this experience, I really got to fight to, to earn, money in the real world. And my first job was like 100% commission. And, I've just always had to hustle. Right. But a lot of my positions, it was like, trying to figure out the corporate world, it's very different from the Marine Corps. And like, so trying to figure out the corporate world and then barely getting a job that was like less than half of what I was used to making. And it was just insane. And then getting laid off. And so I would go through these phases where, I would get back to my lifestyle and, I have my bachelor pad, my condo downtown. And then I have to like, I get laid off and I'm like, okay, so I don't know where my money is coming now. Like, so I'm going to have to move out. I have to move in with roommates now, and so I went through that kind of cycle but I was always like working my way up. Right. So I went from like 100% commission, making like, making like 40,000 a year and 50,000 a year in commission or whatever, to like making 120,000 a year within 6 years. But I got laid off again. And I'm like, I cannot keep going through these cycles. So I'm like, I don't think it's a good fit. So I think I'm just going to, I'm going to go on my own and I'm going to work it out, and, if I have to die by the sword, or I'll live by the sword, die by the sword on my own terms. And so, I became this entrepreneur. I started my company and within a few months, I was doing like 20K a month in revenue, bootstrap and this and that. And so,
so how did you get there? I read about it, like you went from 0 to 20K in monthly recurring revenue within 3 months. Kind of like, what was your path? Yeah.
Huh?
What was your path? How do you scale so fast from 0 to 20?
Freaking just sell and build relationships and sell. And like, at the end of the day, look, I was never a venture. That company I started, like, I will never see that, oh, this is a venture capital institute. This company can be a VC company. It was never that. And I never wanted it to be that, but what I wanted was the freedom to have I wanted the freedom to have control, and so that's what entrepreneurship allowed me. And as I began to kind of, build relationships and make more of a presence in the work that I was doing, I got introduced to a VC firm, right? And so then I started thinking, I'm like, man, I could like not just build one company, but I could build multiple companies. And so it's like that Marine Corps thing, right? Like leveling up, right? And like always trying to do better and always trying to challenge yourself and not staying stagnant and to I made it mentality, right? Because you never really make it. And so I don't, and that goes along with like self-improvement, right? Like I don't really think that I've made it just because I'm a venture capitalist or I've raised this fund or whatever. Like I haven't made it until like freaking, I've got like until like I've built like so many other leaders and whatnot. Like I haven't really made it. And even then I don't think I've made it, because how can you envision yourself as having made it when there's always something to learn? The world is always changing.
Agreed. And so when we'll come back to the investment thesis for Digerati, but like when you decide to invest in a company, are you like wearing your kind of like Marine hat and you're like, I'm going to help this founder or founders or a leadership team scale to new heights, and I'm there to like build them up? Kind of like, what's your modus operandi when you invest in a company?
My modus operandi is well, it's a lot of things, and I call these the most important things when you're evaluating a deal. I call it the three most important D's of venture capital: data rooms, diligence, and disclosure. I mean, you would be surprised. Oh, you're in venture. So maybe you wouldn't be surprised, but like a lot of people would be surprised of how screwed up each one of those are. Like the data rooms, messy, no controls over permissions, no naming conventions. Their documents aren't up to date.
And that doesn't matter in the financial model, or the financial model doesn't tie to the pitch deck.
100%. So, data rooms, diligence. I look at who's on the cap table and like who's doing the diligence, right? Like, and then you'll get like people on the cap table that rely on other people's diligence, and then they do the diligence one time and they think, oh, well, we don't need to do it again, right? And then disclosure. I've had to dig information out of founders, and I'm like, I really shouldn't have to dig information out, because the thing is like if someone puts money into your company and then like, whether you accidentally withheld the information or the information was accidentally incorrect, like you really need to make sure it's correct. And that's where audits come into place. And a lot of founders like, oh, I don't want to pay for an audit to do the round. Well, it's you probably should, because like, if you do multiple rounds and then, people find out that something was missed and, things go awry, then, it's your ass on the line, So, those things are kind of like my modus operandi. But the biggest thing is, Max, is like, who's the person that I'm working with, right? Like,
100%.
What's the quality of this person? Do they have integrity? Do they execute? Do they exude those true, leadership hallmark qualities?
Makes sense. I mean, we're seeing this firsthand all the time. I'm a CPA, so some of the things that you're saying, I'm like, trust and surprise. I mean, time and surprises kill all deals. Like you should never fight about anything. So, and you're talking about some of the trust signals that you want to see there. You want to see something that's organized. You want to, you want proactive disclosure. You want transparency. Like just like if you tell me these are the milestones, hit those milestones. Like build that trust and credibility with me, so like I believe in your story. Otherwise, you just gotta fall apart.
Yep, 100%.
And so what I mean, you talked about trust, you talked about integrity. Like what other credibility signals or trust signals can a founder enshrine in what they're doing or build in order for an investor like yourself to say, oh, they've cleared the first hurdle. I'm now interested in the picture on them is complete. Now I can move on to the picture on the company.
Yeah. We talk about the soft skills, but then, let's move over to the hard skills, right? Like, do they understand the room that they're in, right? And so, unfortunately, the industry has created a belief system that today, in the 21st, in almost the mid 21st century now, venture is the standard, right? And like, so they've kind of created this belief system, and because there's a lot of popularity, there's a lot of kind of Hollywood, there's a lot of Hollywood and venture kind of, so what do I mean? I mean, in the early 2000s, you had the .com bubble.
Yes.
And then, you had the sale of PayPal, and then you started having the social media, phase, right? And a lot of companies just, they started, kind of raising venture out of the Silicon Valley, and then the Safe Note was created to make it easier and less expensive for founders, right? And so what's happened over the years is, you've seen a proliferation and expansion of money across the board because of that .com bubble, right? And it's all kind of like converged. It converged in Silicon Valley, but as people began expanding and they had the financial freedom to be able to, take, money from, if they were a part of the PayPal mafia, or if they were an employee of the PayPal mafia or whatever, right?
Yeah.
Like they still got to exit, right? Like it's amazing, like how many millionaires that .com bubble made, right? And so these people went off and they started like other Silicon Valleys, whether it's Austin or Boston or whatever, right? And so you've seen these other cities kind of start to emerge as like miniature Silicon Valleys. And over time, this has created a culture, right, in some of the more progressive cities in America and now globally. And that culture is a way of thinking, right? And then you have the Safe Note, right? And so, fast forward to 2026 now. Now you have children that have grown up in this culture, right? They may have been born in the .com bubble. Now these people are like 25, 26, and they're starting companies, and they've been taught these things, right? And they're like, but they don't look deeper, right? And so everyone kind of thinks that, oh, I should just form a company, polish up a pitch deck, and the first thing I need to do is go raise venture. And so really, what's important is the hard skills and understanding how this industry works. And the first thing you should do is understand how the industry works, not create a pitch deck and go raise venture capital. When I get founders pitching me all the time that I'm like, it is very clear you do not understand the industry or how it works or what you're getting involved in. And so understanding, the institutional aspects of the industry, understanding what is the point of venture capital, what other kinds of capital are out there, right? Do I really need venture capital? Because you don't necessarily need venture capital to get investment. Anybody can invest, right? It doesn't have to be venture. There's venture debt. There's traditional debt, there's lines of credit, there's ARR financing, which is really blown up in the last 10, 15 years. And I'll close out with saying the history of venture capital started, I'm sure there were forms of barter and trade and investment and thousands of years ago. But as far as modern venture capital, it was founded in 1946. The industry was by American Research and Development Corporation. They were technically the first venture capital company. And the difference between 20th century venture capital and 21st century venture capital is that 20th century venture capital was really about how do we fund innovation to better the economy, to better our lives. 21st century venture capital is like, oh, if it looks like it can be $1 billion company, let's just throw money at it. It doesn't matter, if it really improves people's lives. And so I'll pause there.
No, I completely echo your thoughts and comments. So we publish a ton of content on futureventures.ca, and the primary reason is to drive some of this clarity, because a lot of people assume that they have a venture backable company, and so what we're trying to essentially drive clarity is like, you may have a great company, you may be like highly profitable, you may have all of these ingredients, but the idea is like, are you building a company that has the ability to scale to like extreme heights, something that could be a global? And so that's what they need to understand. It was like, well, I'm making $40 million in revenue. I'm like, that's fantastic. Can you scale it to be $400 million? So no, I echo your comments. Now, you talked a little bit about the safe. I have a couple of questions for you on kind of like the mechanics. You developed the proprietary financial instrument, the Reloadable Note. So I want to get your thoughts on safe. How do you view them? And two, what prompted you down the path to actually build a Reloadable Note? And tell me more a little bit, kind of like, what are the mechanics behind the Reloadable Note?
Yeah, so I think I'll start with the safe, and how I feel about it. Okay. I'm not going to say that the safe doesn't have its place. Like, I mean, it would be illegitimate of me to like completely denounce the safe. I'm not saying like don't use it, or that it's not a good instrument in certain situations, right? But the thing is, every situation, and so venture capital is dynamic, right? And so you need to have a capital strategy. That's my biggest problem with the safe is it's the dumbest instrument. Like, it's the most like simple instrument. That's literally what they call it, right? A simple agreement. Like, you know what I mean? Like, it's the most like dumbest instrument that you could use. Like, not dumb like in a negative way, but like it's not sophisticated at all. And venture capital is like it's very sophisticated with regards to like strategy and different types of capital, and how to keep your company from getting diluted freaking through below sea level and stuff. So like that's the biggest thing, is just like it's very ambiguous. And I'm like, oh well, early stage investors, so a lot of it is like, early stage investors, so in my opinion, early stage investors are taking risk, right? They're taking the first risk. They shouldn't be launched into like a sea of ambiguity. So that the next round of investors can simply decide what to price the round at. And so like if you're an early stage investor and you're taking risk, like why would you let some other downstream investors, like, why would you subject your investment to downstream investors and what they might or might not price the round at?
Yeah.
Like, to me, that it just doesn't make sense. And then the founder, like, I know that you can set like this, the valuation trigger and the discount and all of that. But there's no, so there's no minimum value. Like, how do you keep your company from getting devalued? You know what I mean? So, like, okay, you can set like a valuation cap, but what about a valuation floor?
Yeah.
Because quite honestly, like, if you don't have a valuation floor, that tells me one thing: you don't believe in what you're building, and you don't have conviction to say, like, hey, we're never going to be less than this. Like, every company has like a biological value. Like, what's your biological value, right? And so, to me, like, why would I invest in something that I know doesn't, like, it could, like, if the founder doesn't have enough balls to say, like, hey, I know we won't go below this value, and let's set the floor there, then I don't want to put my money in it, and I think that's the way, that's the way mature investing works. Like, I mean, if you look at, trading, like traders, or look at the Dow or something like that, like, just look at the way that mechanics work on stock exchanges. They usually set like trading floors, right? And so I mean, that's a little bit out of my realm. I'm a venture guy, but I'm pretty sure that, like, stock traders and, sophisticated traders, they don't put their money into things unless there's like a floor, right? And so that's where the reloadable note comes in. And in terms of why I came up with the reloadable note, quite honestly, I was selected out of a couple thousand people to go through VC lab with Adeo Ressi. I don't know if you know who Adeo Ressi is. So Adeo Ressi came out with the convertible equity note or something. I forget what he called it, but the guys at Y Combinator said, hey, we'll popularize it, and then they called it something else, which is what we have as a safe note today. And so actually I have the screenshot somewhere, but Adeo posted it back in September of last year, 2025. I think the safe note is overused, and I think we need something new. Say no more. So I was like, okay, so I've been a founder and an investor. What are the quagmires? What are the complaints on each side when deals happen? And I'm like, well, as a VC, okay, so we're talking about future. We're talking about futures a lot of times, like future metrics. But what do LPs really care about? What's the present value of the portfolio? And I'm like, well, DPI is really the most important. And for those of you that are listening, distributions paid in. Okay. So that's really the most important metric in my opinion. That's the real present value, right? And so why do we need to wait, 7-10 years to realize the value until we get an exit, right? And then at the same time, founders are getting diluted way too early, right? So I wanted to provide some flexibility there, which is where the reloadable note comes in. And if you like, I can explain the mechanics of that.
I would love that, because I think that I share your thoughts on the safe. And so any instruments, so as a result of some of these constraints, we're seeing like emergence of secondary funds, and you've seen the emergence of different. So obviously the goal that every founder has is to keep as much of the equity as possible. Of course, they need to give up some of it in order to get the funds to scale. But it's kind of striking that balance between dilution or giving up equity and grabbing as much momentum or scale. And so any instrument that would provide for that, for this healthy balance, is in my opinion, it's something that should take off.
Yeah, no, I appreciate that. Really, the reloadable note is an early stage instrument. And so what it's meant to do is, number one, keep founders from getting diluted. Number two, provide real-time optionality to investors for liquidity, right? Earlier on liquidity.
Yes.
But also providing some some incentive to reinvest into the company. So the way the note is essentially designed is you have participation proceeds, anytime there's a defined liquidation event or trigger, right?
Yes.
And so let's say I have $1 million, right? And I want to invest it in John's Donuts, right? And so, I'll put, let's say I put the $1 million in, right? And 500 goes in as equity, right? And then the remaining 500 we're going to reserve for the next liquidation or trigger event, right? And so what that does is it allows the founder to get the money, but it also keeps the cap table clean, right? Or it keeps the cap table lighter, should I say. And then from there, when the next liquidation or specific trigger event happens, at that point, and it can be, the liquidation and trigger event can be whatever you want to define it as, right? Like it can be, if you hit a certain revenue milestone, it can be, if, a future investor puts money into the company, for example, because they're going to have to buy into the company anyways, right? Like, so they're going to have to, so if an investor is putting money into the, like a future investor is putting money into the company, then that, so essentially, like if they're going to put, let's just say 5 million in, right? Then that's going to dilute the previous investor, right? If the previous investor put the whole $1 million in, right? But instead of diluting the founder more and the previous investor, right? Instead of doing that, we just take the 500 and we can define that as a liquidation event. And then what we have there is a buyout, an early buyout or early exit. But that earlier on investor still has the option, if they want to take that buyout, they can reinvest or reload that 500K at the original valuation, right?
Okay.
And they can reload it at the original valuation. We're anchoring to the original valuation, right? So they can reload at the original valuation because they took the earlier risk. And so they should be able to reload at a lower price, right? Because they took the risk to do it, right? So that's kind of how it works.
Okay, so that's different from setting aside follow-on capital. Would the new investor coming in object to this? Because essentially, somebody is having a preferential rights in terms of, like, they have the ability to put new capital at previous valuation, where the new investor has to put new capital at the new valuation.
So they may, I mean, they may object to it. But again, so the ethic, the substance and really the heartbeat of what the point of the note is to keep the founders from getting diluted, but then to provide the investors earlier on liquidity, right?
So how does the note determine who the 500,000 in terms of buyout goes, in terms of, like, so I'm assuming that the 500 does not buy out the founder shares. It goes towards the early stage investors in terms of as you said, you want to keep the cap table light.
Yeah.
So
Right.
it's buying out some of the early investors that want to hit the off ramp.
So like with the earlier with investor number one, the first investor, the second investor can buy out that earlier investor, and so there's liquidity there, right? They don't have to have to sell. The first investor doesn't have to sell off the entire 500,000. Let's say they they want to buy out 250,000, and that keeps the cap table clean because that's not going in as equity. Does that make sense?
Yes,
right?
Yes, it
so
does.
That's not going in as equity, and so then that payout goes to the earlier investor, but it's not going in as equity, which means that the second investor's money is going to actually go further, right? But in terms of in terms of like the second investor not being appreciative of the first investor taking on the earlier risk and being able to reinvest at the original valuation, I would have to fight back on that because the $1 million was put in originally at the original valuation, right? So they should be able to take that that capital and actually, I'm sorry, I'm telling you, I'm telling you wrong. That reinvesting, that would actually, I'm not looking at the note right now, but I'm sorry, reinvesting or reloading that capital would go at the new valuation. I'm sorry.
Oh, I see. Okay.
Yeah, I did tell you wrong on that. But with the $1 million, that would be anchored towards the original valuation. Does that make sense? So any liquidity that comes out would come in at the new valuation that the second investor sets.
Makes sense. That makes sense. Would you happen to have a reloadable note that we can put in the show notes as a template?
It's actually there is a FAQ, a white paper
on the Digerati investments.
No, I don't do anything like that with Digerati. So I have another company that handles all of our administration, syndications, SPVs, and due diligence. Here's the page for the note. So the note sits under reciprocity, but again, just you can read through the terms and the mechanics and everything. But again, I want to reinforce the key is non-dilution, incentive to reinvest and double down on the company, right? So again, if we take that 500, we can reinvest that at the new valuation, right? But the first $1 million goes in at the anchored valuation, okay?
Got it.
And then we have freedom to design what is classified as a liquidation or a trigger event.
Got it. Really like some of the features of the reloadable note.
I appreciate that.
With Digerati, you invest in early stage AI companies. What's your take on the current AI market?
Oh, that's a great question.
Yeah,
that's a great question, man. So I served in the military during ground combat missions, but my last 2 tours in Iraq, I ran a command intelligence center, and that's when the military was just getting into the hardware side of AI, right? Like drones, detection systems, etc. I think with where on the commercial side, I think on the private sector, I think with where AI is at today, I think reality has hit the market, and this is the thing is like anytime you have a lot of hype in a market, or in any environment, there's a lot of hype and hysteria and this and that. Just give it time to calm down, right? Like it's like a boiling pot of water. It's like just let it go to a simmer and then a cooling state. And then and then the water's not distorted and we can actually see through the water, right? And so like the market's like that, right? Like so anytime there's a lot of hype, just give it time for the water to settle,
I don't
and then
know.
we'll see what the reality is.
Yeah.
And the reality is that we've seen a lot of companies building, AI, paper. I would say paper shack products.
Yeah.
That they're flimsy. They don't. They're not going to be around in a few years.
Yeah.
We've seen companies like that.
Yeah.
They don't really make a difference, and you can actually, when it comes to SaaS products, you can actually tell who the good companies are. Like, there's products that I use like that have saved me so much time, and like they've actually given me a lot of knowledge. They've made me better, and so like you can tell which companies are building AI correctly, which ones are doing it right, and which ones are not. And the ones that are not doing it right, I don't even use those products. I don't even remember those products. So, the other thing is that companies today that are building like AI today the right way, that are, whatever term you want to call it, unicorn, generational outlier, any company is changing the way that we live and work, and any company, these companies are going to be around. These are going to be the next Googles and open AIs and Amazons. They're going to be the next company. So those are the companies that are like that are being built today, are the companies that are going to be around. Anything else that isn't changing the way that we live and work and things like that, it doesn't even matter. Like, they're not going to be around. And so you can look at it like, again, the .com bubble. You can look at Google. You can look at Facebook. Any of those companies. And you can look at payment infrastructure, PayPal, and look at those companies and how everything has been built off of those, because those were the foundational companies of social media and the internet and this and that. And AI is going to be the same. And so, whatever the foundational companies are between, I think, now and 2030, are going to be the foundational companies. And then in 2030s, we're going to see the layers build on, right? And then I think, as we get into the 2030s and the mid 2030s, at that point, I think we'll start to maybe get into the next levels of artificial intelligence, such as, deeper levels of general intelligence, deeper levels of quantum computing, and maybe even sentience.
Yeah. Are you more excited about the physical AI or digital? Like the physical world, or kind of like when it comes to AI?
Well, like, what's really the point of AI is like not to sit here with a device. That's not the point of AI. So like the point of the future of AI is like total immersion, literally. Like, so, I think, to answer your question, I used to be a venture partner at a firm called the Robotics Hub. Their flagship portfolio company is actually Agility Robotics, right? And so, I think for the future, robotics is where it's at. And I mean, you can look at what other countries are doing. You can look at the conflict in the Middle East right now. Someone asked me the other day, are we putting boots on the ground? I'm like, look, I don't think it's going to be another Iraq or Vietnam. This is very different. This, the future of war has changed. Things have changed. We are at a turning point. There will, be some boots on the ground. There's probably already boots on the ground in Iran. It's just not being said, right? It's covert operations.
For sure.
But we're not sending the airborne and the Marine expeditionary units there for a desert oasis vacation. Like, we're sending them there because it means something. And
Yeah.
so there will be boots on the ground, but nothing like Iraq. I mean, America. So when I ran the command operations center in Iraq, we were the trailblazer for drones. Like, nobody talks about that because drone warfare really hasn't happened until the Ukraine, right?
Yes.
Yeah, but we were the first military to put drones in combat, right? And so, I think so the US has plans to purchase over 1 million drones within the next couple of years. 1 million drones. I mean, that's insane. That is insane. Yeah. And so when you have 1 million drones, why the hell do you need like a bunch of boots on the ground? When you have 1 million drones that can spy and drop bombs and shoot, like, I mean, that changes the dynamic, like, in so many ways. So I think, where we're at with AI now, to go back to your question, is twofold, right? I talked about the commercial side and foundational companies.
Yeah.
But then I talked about the more of the government side, or in terms of like defense, and so I think that's kind of where we're at. And then I also believe that AI is going to be so we've largely been looking at how do we regulate AI at the organizational, at the government level. It doesn't work, does it? Because, when cars first started getting manufactured, as an example, like, you can only regulate cars so much, but like, somebody's got to control like the drivers, right? And so we got all these rules of the road. You can take a Ferrari out or a Dodge Charger, but you're not going to drive it 200 miles an hour down the road because of the rules, right? And so AI is kind of the same. I think we're going to have more laws and rules around, everyday consumer use.
Yeah, I know. I hear you. And I think in many ways that's needed, because AI is facing, well, at least in the public perception, is more negative than positive about AI, despite the fact that it's just going to become ubiquitous technology that we use in everyday life, in every aspect of life. And
I think, like, if you're not if you're not implementing AI into your business, and then, like, again, if you're not using AI as an extension of yourself, I think you're already behind. And like with VC firms, every VC has a different thesis, right, and invests differently. I think the VC firms that don't have their own proprietary AI product that matches their thesis, I think they're behind. I use AI for everything that I do, but I don't cross the line of AI dependency, right? Like, so
it's
like,
not a substitute for human intelligence. You still use it because it speeds up everything. But
like, I don't say ask AI a question, like, or if I have an idea and it gives me an answer, I'm like, oh, that must be right. No, like, I think deeper. So AI is meant to be an aid. And if you're using it correctly, I think, like, if I were to look at my work 5 years ago, my life has changed forever. And so OpenAI is one of those foundational companies, right? Like, but if I were to look at my work 5 years ago, I'm like, geez, man, my work has improved so much because of AI.
Yep. Well, it allows you to find the answers of questions that you are posing. Before, you might have forgone going and getting the answers, because it would have had to scroll through a series of pages on Google or wherever. And now the answers are at your fingertips. So it gives you that speed, velocity, but it gives you the precision. My biggest comparison around AI is that AI enables everything to go from one to many, or from macro to micro. Everything becomes one to one. We work with a number of like AI companies that they're in the life sciences, but everything is becoming personalized. You no longer need the broadcast model. Everything is one-to-one, unichannel.
100%. Absolutely. It's really exciting. I mean, geez, I just There's so much that you can do with AI. I think it's pretty amazing what humans have created.
What are your top 3 favorite tools that you use in your work or personal life?
Well, being in the space that I'm in, right? So I'm doing a lot of writing.
Yeah.
Like there's platforms I write for an innovation platform called Idea Scale. I write for the AI Institute. I've just been accepted in the Forbes Finance Council, so I'll probably I'll be writing bylines for them. Fantastic. And so forth, and on. But so writing, and then a lot of what I'm doing is I might be creating materials or so decks and presentations. Yes, even as a VC, you still have to create decks and presentations.
You're fundraising too. Yeah, absolutely.
Yeah. So so I'm doing things like that, and the thing is like I could never outsource deck creation because I'm like, no one. What I do is so specialized. Like I have to do it. I can't pay anyone to do it. So I'm doing things like that. And then just in general, just every day, like for example, I'm an athlete, right? Like I've been in athletics for like over 30 years, and so I'm like, geez, how can I improve my VO2 max? Things like that, or like how can I improve my resting heart rate? Like if my resting heart rate is at like it's my resting heart rate is in the mid to upper 40s.
Okay.
Yeah.
Wow.
Yeah. So I'm like, what can I do to kind of like keep it there and things like, so self-improvement and things like that. And Chat GPT, Gamma has been really amazing. Read AI is amazing. Because I'm able to like so if I have like 50 meetings a week or whatever, I can like take all my notes and I can find like, I can take all my notes and I can be like, okay, what is the pattern? What is the consistent pattern or the constant versus the variable, right? Like what's the constant between all these meetings? And then how do I leverage that, right? Like, so it's not what, it's how, like, it's how you're using AI. And you don't need, every tool. Like I've named my I've named my Chat GPT Zeus, but like Zeus. I named it and I recommend that that more people name their AIs. That may sound weird. Like some people's no, it's an inanimate. It's an it. It's I'm like, no, you need to personalize it. You know why? Because we need to hold AI accountable. And we don't hold inanimate objects accountable. We hold people accountable. Right. So if we start personalizing it, then we'll start acting in ways that hold AI accountable. Right. But if we look at it as like a non-human form, then we're not humanizing it. So we do need to humanize it because AI is becoming more and more human, right? And so
for sure,
I think those things are important. And again, think about kind of like how you need to think like AI, right? Like, so don't think like how you always think, but look at how AI processes things and think like an AI system,
for sure.
And so, those are the things that I would look at, and just, how I've kind of, built AI into my life.
Amazing. Paul, you've been extremely generous with your time. Love the conversation. If somebody wants to follow your work, what's the best place to do so?
Best place to do so is to just look me up on LinkedIn. I'm the only Paul Anthony Claxton. You can also find my website. It's paulclaxton.io. Or, let's just hop on a Zoom and
Amazing.
see where we align and land in a line and see what we have in common and might be able to work on together.
Amazing. Amazing. Thank you, Paul.